Hi, this is Pattu from FreeFinCal and welcome to another edition of Mutual Fund FAQ, where we discuss some of the basic questions that investors have regarding mutual funds. So we've been talking about debt mutual funds in a series of videos. I had said that debt mutual funds is one of the biggest reason why one should consider investing in mutual funds, and I had also explained what are the tax benefits associated with the debt mutual funds and what is a debt mutual fund and what does it do in general. In this video, I'd like to talk about what are the risks associated with a debt mutual fund. Now, there are, of course, as with any mutual fund, there are multiple risks. We will cover the two main risks. One is called interest rate risk and the other is called credit rating risk. Now, let's say you buy a bond that offers 8% interest rate. Now, as long as your intention is to hold the bond and receive regular interest payments, and upon maturity you will expect the money back given to you, then there's no problem, right? But in a debt mutual fund, the bonds that the fund manager buys are marked to the market. That is, the value of the bond every day will correspond to the actual market value of the bond. That is the rate at which the bond will be sold. So let's say the fund manager holds bonds that has got 8% interest rates, and tomorrow the RBI says the interest rates are decreased by, let's say, 1%. That's a huge fall, but let's say it decreases by 1%. Now, the bonds that the fund manager has got 8% rate. New bonds from tomorrow will be issued at 7% rate. So, which will be more valuable? Obviously, the fund managers holds bonds which has got more rate, and therefore the value, their market value or the price at which they can be sold will suddenly jump up because new bonds are available at a lower interest rate. So, when interest rates move down, the NAV of a debt mutual fund will move up because the market value of the bonds that it holds will move up, right? Conversely, if the interest rates move up to 9%, RBI says interest rates increase to 9%, then the 8% bonds are not so valuable. So then the new bonds are more valuable because they offer 9%. So then when the interest rates move up, the bond value moves down, and therefore the NAV also will move down. So that is the converse, the inversely proportional movement, right? When the rates move up, the NAV moves down, and the rates move down and the NAV moves up. However, please note that you don't have to see an actual rate hike or a rate lowering by RBI. The anticipation that RBI will change rates either up or down will slowly change the demand and supply in the market. And because of the anticipation, so suppose there is an anticipation that in the next quarter meeting the RBI will decrease rates, then gradually the NAV of the mutual funds will move up over a period of time. Similarly, the other way is also possible. So you don't need to have an actual change in rate. The anticipation itself will cause the NAV to change up and down. So this is the interest rate risk. Now, it is very important to understand that the interest rate risk is not subject to government bonds alone. Now, any bond that the debt mutual fund has will be subject to interest rate risk, interest rate fluctuations. And the thumb rule is, the longer the maturity of the bond in the portfolio, so the longer the average maturity of the portfolio, the more will be the interest rate risk. So if a fund only holds bonds that mature overnight, so tomorrow new bonds can be bought, then there is absolutely no interest rate risk. See, today if I am holding an overnight bond, and today if RBI changes the rate, whatever it does, tomorrow I can buy new bonds. So there is absolutely no interest rate risk associated with a overnight bond. Now, instead of an overnight bond, suppose I hold a bond that matures in 20 days or 30 days or 40 days and so on. then also the interest rate risk will be low. There will be a small change there will be a small effect due to the interest rate change or the anticipation of the change, but the effect will be small because anyway in the next few days the bond will mature and I can buy a new bond. But suppose I am holding a bond that is going to mature in 20 years time, and tomorrow the rates have increased. Now, then the price of the 20-year-old bond will fall a huge amount, because nobody will want to hold such a long-term bond with low interest rate, right? So, longer the interest rate, the higher will be the fluctuation in price when the interest rates change or the anticipation of the interest rate change sets in. So that's very important. So always avoid investing in debt mutual funds that have an average maturity more than I would say more than 1 year. If you are comfortable, you can go up to 2-3 years, but beyond that don't go, because if you invest in debt mutual funds that buy long term bonds, then the interest rates fluctuations will be very violent, and it will take a long time to recover. That is also important. So if you hold let's say a 3-month bond and suddenly the NAV drops due to some reason, the recovery will be fast in the case of a short-term bond. But if you hold a fund that holds bonds that mature over several years, then if the NAV drops down, then the recovery will take a long time. So don't buy mutual funds. I would say if you are a first time investor, don't buy mutual funds, any mutual funds that has got an average portfolio maturity of more than 1 year. Stick to few months ultra short term bonds or liquid funds. That is enough. Those two kind of funds are enough. You don't need any other fund. So that's the first type of risk, interest rate risk. The second type of risk is a lot more dangerous, and that's called credit rating risk. Or now the advantage in an interest rate risk is you will see it every day. You will see that risk manifest every day in the NAV. So it will move up and down, and you can actually reason out why did it change. You can look at the bond yields and make a reasoning what is happening in the market and so on. But when it comes to credit rating risk, this is an invisible risk, and therefore it is extremely dangerous, and you cannot rely on star ratings to tell you whether there is a credit rating risk present or not, because mutual fund star ratings will offer more stars to funds that offer more returns. And in the bond market, if a bond offers a more interest rate, then it means that the issuer or the company which gives the bond has got a problem. That is, the reliability or the repaying capacity of that company is suspect. So when it comes to bonds, the government bond has got no credit risk, or rather within India we cannot rate the repaying capacity of the government. We have to assume that the government will always repay in full. There is no problem. Of course, international agencies will do a credit rating, and India does not have a great credit rating. It has had worse credit ratings in the past. It had almost went up to the verge of bankruptcy in the 90s. That's another story. Let's not get there. But within India, we must assume that the government will always fulfill its obligation, and therefore the government bond is called is given a sovereign rating. So that's a special rating. Any other financial organization or a business which offers a bond will be graded relative to that sovereign rating. Now, if the company has got solid financials, there's practically not much debt except the one that they are presently taking on and so on, then the interest rate will be low. It will be a little bit above the government bond, because there is always some risk when it is not a government organization, but it will only be a little bit extra. But as you go down the scale in terms of the repaying capacity, as the repaying capacity goes down is more suspect, then the interest rate it must be higher, because the bond buyer should be compensated for the risk they are taking. This is an invisible risk, because even if the rating is very low and therefore the interest rate is, let's say, 12%, as long as the company is able to give you the 12% interest, there will be no problem. The NAV of the mutual fund will nicely increase. You will feel that returns are very nice, fantastic. One day, let us say the interest rate payment is delayed and there is a default, then immediately there will be chaos. Immediately people will say, oh, this company has defaulted on payments, therefore we will not, the market value of such a bond will plummet. When the value plummets, then the NAV will also plummet. It will drop like this, it will drop vertical. A stock market crash will at least go down like that. When a bond crashes, it will cross like a plumb line, right down vertical. And therefore, very few people will say, I will buy that bond. So this is the problem. And a mutual fund will buy tens of crores of such bonds, and that will be a problem for the mutual fund to sell it. In fact, Franklin Templeton has been in this problem, and Franklin Templeton AMC itself has purchased the bonds from that fund to bail out that particular mutual fund, and this is well recorded. So this is the biggest problem with credit rating, is it is an invisible risk. So star ratings of a credit rating fund will be extremely high, it will be 5-star. Then when there is a credit default, when the NAV falls down, immediately it will become 1-star. And then after a few months everything becomes okay, suddenly it will become 3-star or 3-star, 4-star, 5-star again. I've seen this happen. So this is the problem. People don't understand this when they buy, and you have to be very careful in choosing funds that take on credit risk. That is, they buy bonds with low credit rating. If you want to take on credit risk to get more return,